Stop. Before you scroll past this, you need to hear what just happened. Morgan Stanley, one of the oldest, most powerful financial institutions on the planet, just quietly confirmed something that the crypto community has been waiting years to hear. And they didn't shout it. They didn't tweet it. They slipped it into a conversation like it was almost casual, like it was already decided. And if you understand what that actually means, not just on the surface, but structurally, historically, systemically, then what I'm about to walk you through in the next 18 minutes will completely change how you're looking at this market right now. Stay with me through minute 12 specifically, because that's where the pieces connect in a way that most people are going to miss entirely. Quick note before we go any further. This is not financial advice. I'm not your advisor, I'm not your accountant, and I'm definitely not responsible for your portfolio. This is information, analysis, and perspective. What you do with it is entirely your call. Now, let's get into it. Here's the thing about major institutions. They don't telegraph their moves. They don't announce their intentions. They don't put out press releases that say, we're about to shift billions of dollars into a new asset class. They never do that. What they do instead is they signal, quietly, carefully, deliberately. And what Morgan Stanley just put out into the world, through a senior level voice in a fairly low-key setting, is the clearest institutional signal on Bitcoin that we have seen from a major Wall Street bank in this entire cycle. The message was essentially this: US banks will hold Bitcoin on their balance sheets. Not might, not could, not are exploring. Will. Now I want you to hold that word for a second. Because when a firm like Morgan Stanley uses language like that, present future tense, no hedge attached, that's not a prediction. That's not speculation. That's positioning language. That's the language of an institution that has already run the analysis, already had the internal conversations, and is now beginning to shape the public narrative around a decision that's already been made internally. Morning, afternoon, or night for you right now? Drop it in the comments. I'm always curious where this channel reaches. And more importantly, have you been watching institutional moves closely enough to notice when this kind of language shifts? Because most people weren't watching when it did. Let me show you why this moment is different. Let me give you some context, because the context is everything here. For the past 2+ years, the conversation around institutional Bitcoin adoption has been loud, messy, and frankly, exhausting. Every few months, another bank would release a research note. Another analyst would say Bitcoin was interesting. Another fund would dip a toe in. And every single time, the retail crowd would go wild. Prices would spike, and then nothing would actually change at the structural level. That cycle repeated itself so many times that most people stopped paying attention. And that's exactly why this moment is so significant. Because what Morgan Stanley just communicated isn't a research note. It's not an analyst opinion piece. It's not a client-facing marketing document designed to seem progressive. It's an internal strategic position being verbalized externally. And when institutions do that, when they stop hedging and start stating, it almost always means the internal debate is over. Hit, like if this is starting to make sense because there's a specific reason institutions communicate this way, and understanding that reason tells you everything about where we are in the timeline. Here's the thing. Most retail investors fundamentally misunderstand about how large financial institutions operate. They don't decide and then move immediately. They decide, then they wait, then they create the conditions, then they move, and the gap between the decision and the move, that gap, is where the opportunity lives for everyone who's paying attention. Right now, Morgan Stanley has publicly reached step 1. The decision has been communicated, which means the clock is already running. Now here's the part nobody is paying attention to. If banks have already made the decision internally, why aren't they buying right now? That's the question everyone should be asking. And the answer has 3 layers, and each layer is more important than the last. The first layer is regulation. Banks in the United States do not operate in the same universe as a retail investor opening a Coinbase account. They live inside a framework, capital requirements, risk classifications, custody standards, reporting obligations that touches every single asset they hold. And for Bitcoin, that framework is still being completed. The SEC has moved. The CFTC has clarified some jurisdiction. The OCC has made noises. But the unified regulatory clarity that a major bank needs before booking Bitcoin as a balance sheet asset, it's still coming together. Now here's what most people get wrong about this. They think regulatory clarity slows adoption. It doesn't. Regulatory clarity is the unlock. The moment a bank can point to a clear rule set, a clear capital treatment, and a clear legal framework, that's when the gates open, not slowly, fast. The second layer is accounting. This one doesn't get talked about enough. Historically, Bitcoin on a corporate or institutional balance sheet was subject to fair value accounting rules that punished you every time the price dropped, even temporarily, without crediting you when it recovered. The Financial Accounting Standards Board updated those rules recently, allowing Bitcoin holdings to be marked at fair value with both up and down movements recognized. That was a major shift. But full integration of those standards across the banking sector with all the internal policy rewrites that requires takes time. The third layer is competition dynamics, and this is the most psychologically interesting one. No major bank wants to be first, not because they're afraid of Bitcoin, but because being first means absorbing all the regulatory scrutiny, all the media pressure, and all the volatility optics before the asset class is normalized. But being second or third, that's comfortable, that's safe, that's following best practices. So what every major institution is doing right now is watching the others, waiting for someone to take the first step. And the moment that happens, the moment one significant bank formally books Bitcoin on their balance sheet, it becomes a competitive race, not a cautious walk. This is where things start to break down for people who think this is going to happen slowly. It won't. Let me take you back for a second, not to crypto, to history. Because every major asset class transition in the last 100 years has followed the same rough pattern. There's always a discovery phase, when the asset exists but is considered fringe, speculative, or misunderstood. Then there's a legitimization phase, when credible voices start acknowledging the asset's structural role, but institutions are still cautious. Then there's the trigger phase, when one major event, one regulatory shift, or one institutional move cracks the dam. And then there's the compression phase, when everyone who was waiting and watching rushes in simultaneously, and prices move far more aggressively than anyone expected. Gold went through this cycle in the 1970s and again in the 2000s. Tech stocks went through it in the 1990s. Fixed income derivatives went through it before the financial crisis. ETFs went through it over the last 2 decades. The pattern is always the same: long, quiet build-up, sudden violent move, and then a new equilibrium at a price level that the cautious majority never thought was possible. Bitcoin is not immune to this pattern. In fact, Bitcoin is arguably the most perfect candidate for this kind of institutional compression because of one specific feature: supply. There will only ever be 21 million Bitcoin. That's written into the code. It's not a policy that can change. It's not a supply curve that can adjust. It is mathematically fixed. And of those 21 million, a significant portion is already effectively locked. Long-term holders who haven't moved coins in years, wallets where private keys have been lost, addresses that haven't been touched since the early days when Bitcoin was worth pennies. The liquid, actively traded supply is far smaller than the headline number suggests. Now, layer on top of that the fourth Bitcoin halving, which took place in April 2024, cutting the rate of new Bitcoin issuance in half. Miners produce less. The new supply entering the market every day is smaller than it's ever been in Bitcoin's history. So the equation looks like this: shrinking new supply, locked existing supply, and the incoming demand from the most capital-rich institutions in the world who have never meaningfully participated before. That's not a recipe for a gradual, managed price increase. That's a recipe for violent, fast repricing. And when you combine fixed supply with suddenly surging institutional demand that doesn't respond to price the way retail demand does, demand that is driven by allocation mandates, compliance approvals, and portfolio theory, you get a price dynamic that is genuinely unlike anything else in modern markets. Comment below if you're already thinking about how your current allocation reflects this, because I want to have that conversation in the replies. Okay, now we're at minute 11. This is the part I told you to stay for, because everything we've talked about so far is the build-up, the pressure building behind the dam. And now I want to walk through specifically what breaks it. There are 4 potential triggers, and any one of them, in isolation, could change the entire trajectory of this market. Trigger 1, a clear OCC or Federal Reserve directive on bank Bitcoin custody. Right now, banks can interact with Bitcoin-adjacent products. They can offer ETF access, they can provide prime brokerage to crypto firms, but holding Bitcoin directly on a balance sheet as a primary asset still sits in a gray zone. The moment a formal directive clarifies that, The gray zone disappears, and banks don't need to debate anymore, they execute. Trigger 2, a sovereign balance sheet move from a credible economy. We've already seen smaller nations move. El Salvador was the early mover, controversial, polarizing, dismissed by institutions. But the conversation has shifted. If a G20 nation or a major reserve-holding economy formally integrates Bitcoin into its national balance sheet as a reserve diversifier, the psychological pressure on institutional holdouts becomes enormous. You can't call it speculative when a developed economy is holding it as strategic reserve. Trigger 3, a change in how Bitcoin is classified for bank capital purposes. Under current international banking frameworks, Bitcoin carries the maximum risk weight for capital purposes, meaning banks have to hold significant capital against any Bitcoin position. If that classification changes, which is under active review in multiple jurisdictions, the cost of holding Bitcoin drops dramatically overnight, and that directly changes the math for every bank's internal allocation models. Trigger 4, the competitive first mover. This might be the most powerful of all, and also the least predictable. Somewhere, right now, inside the risk committees and balance sheet meetings of the largest banks in the world, someone is running the numbers. Someone is building the internal case. Someone is asking, what does our competitive position look like in 5 years if we moved early versus if we waited? And at some point, one of them is going to answer that question with action. The moment that happens, the moment one major bank announces a formal Bitcoin position on their balance sheet, the rest stop waiting. They don't have the luxury of waiting anymore, because now there's a benchmark. Now there's a peer comparison. Now every analyst covering those banks is going to ask in every earnings call, when are you moving? What happens next is the real story. And I want you to really sit with this. Let me put some perspective on what this actually means for price. And I want to be careful here, because I'm not in the business of giving you price targets or telling you Bitcoin is going to some number by some date. That's not what this channel is about. But what I will do is walk you through the structural math, because the structural math is where clarity lives. As of early May 2026, Bitcoin's market capitalization sits in a range that, while significant, is still a fraction of the assets managed by the institutions we're talking about. The combined assets under management of the 5 largest U.S. banks alone runs into the tens of trillions of dollars. Now, let's say, conservatively, institutional Bitcoin adoption, not just banks, but pensions, sovereign wealth funds, insurance pools, and endowments, results in a 1 to 2% allocation from those pools over the next 2 to 3 years. 1 to 2%. That sounds small. That sounds like rounding error when you're talking about $100 trillion pools of global institutional capital. But when that capital tries to enter a market with a fixed supply and relatively thin liquidity at scale, price doesn't adjust linearly. It adjusts exponentially, at least in the short term, because there simply aren't enough sellers at current prices to absorb that kind of demand without significant price discovery happening upward. This is the part that most retail investors genuinely don't understand about how asset prices move at institutional scale. It's not about the direction, it's about the velocity. And velocity in a supply-constrained market with suddenly accelerating institutional demand can be brutal if you're not positioned before it starts. Are you positioned, or are you just watching? That's not a rhetorical question. I genuinely want you to think about that, because there's a version of this story where you're in the room when the move happens. And there's a version where you're reading about it after. Subscribe if you want to stay ahead of what's coming, because this channel exists specifically for people who'd rather be in the first version. Now, I'm not going to give you the bull case and leave out the other side. That's not honest and it's not useful. So let me tell you the risk. The risk is delay. And not just any kind of delay, the dangerous kind. The kind where everything I've just described is structurally accurate, directionally correct, but takes longer to materialize than your patience, your financial situation, or your psychology can handle. Institutional adoption of Bitcoin is coming. I believe that with conviction, and the evidence supports it. But coming and here now are two very different things. And the gap between those two states can be long, brutal, and full of the kind of volatility that shakes out even people who were right. We saw this with gold. Analysts who were right about gold's structural bull case in 2001 spent the next 18 months watching the price go sideways and then fall before it eventually moved. The people who were right but impatient sold before the move came. The people who were right and patient were rewarded enormously. The same pattern played out with tech, with emerging markets, with real estate, with every single institutional adoption cycle in history. Being right about the direction doesn't protect you if you're wrong about the timing, or if you're over-leveraged, over-concentrated, or psychologically unprepared for the volatility that comes in the waiting phase. Do you think the system can hold? Drop your honest take in the comments. I read every single one. The quiet risk in this environment is that the excitement around institutional adoption creates a false sense of urgency that pushes people into positions they can't sustain. And then when the inevitable pullback comes, as it always does in the waiting phase, those people exit right before the real move starts. There's also the macro risk. Bitcoin doesn't live in a vacuum. It responds to liquidity conditions, to rate environments, to risk appetite across markets. A significant global tightening event, an unexpected credit shock, a geopolitical escalation that triggers a flight to cash can and does drag Bitcoin lower in the short term, regardless of the long-term structural case. None of that changes the thesis. But it can absolutely destroy the psychology of investors who weren't prepared for it. The people who navigate this cycle successfully will be the ones who understood the thesis, sized accordingly, and didn't need to sell when the market got uncomfortable. Not because they were reckless, because they were prepared. There's a version of conviction that's actually fear in disguise, where someone loads up on an asset because they're afraid of missing out, not because they genuinely understand what they own. That kind of conviction breaks the moment the market tests it. Real conviction, the kind that holds through volatility, comes from understanding, from doing the work, from knowing why you're positioned and being able to articulate exactly what would have to be true for you to be wrong. So if you take one thing from this part of the conversation, be honest with yourself about which kind of conviction you have. Manage your risk, size your positions. Think in years, not weeks. The opportunity here is real. The risk is also real. Both things are true at the same time. Here's where it gets interesting. Because while the public narrative is still catching up, while most retail investors are still deciding whether Bitcoin is legitimate or safe or here to stay, the positioning beneath the surface tells a completely different story. Over the past 12 months, Bitcoin ETF inflows from institutional channels have continued to grow. Custody infrastructure at major financial institutions has been quietly expanded. Derivatives markets that institutions use to hedge and structure positions have deepened significantly. The plumbing for institutional Bitcoin participation is being built in real time, not announced loudly, just constructed methodically. This is where smart money is already moving, not with aggressive public announcements, with infrastructure, with preparation, with positioning. And this is exactly why this matters right now, because by the time the announcement comes, by the time a major bank makes the public move, the preparation phase will already be over. The opportunity inside the preparation phase is what's available right now, not afterward. Share this with someone who needs to see it before it's too late, because I genuinely believe there is a window here that most people are going to miss simply because they weren't paying attention at the right moment. So let's bring this home. Morgan Stanley just told you something, not loudly, not dramatically, but clearly. Banks are coming for Bitcoin. The structural decision has been made. The framework is being built. The triggers are lining up. The question is no longer if, it's when. And the second question, the one that actually matters for you personally, is whether you'll be positioned before the when arrives. Because here's the thing about inflection points. They don't announce themselves. You don't get a notification. You don't get a countdown. You get a signal, usually quiet, usually buried under 1,000 other headlines, usually dismissed by the majority until it's too late to matter. This was a signal. What you do with it is entirely up to you. But I'll leave you with this. The people who look back on this moment in 5 years and wish they had paid attention, they had access to the same information. They saw the same headlines. They heard the same signals. They just didn't believe it was real until it was already obvious. Don't be that person. If this video gave you something to think about, something that shifted how you're looking at this market, hit like. It helps this channel reach the people who need to see this before it's too late. And if you're not subscribed yet, the next signal is already forming. I'd rather you're here when I cover it than finding out about it after. Stay early, stay informed, stay ahead. I'll see you in the next one.